What's up, investors? Welcome back to AQ Markets. So in light of the controversy surrounding certain brokerage firms like Robinhood restricting trading on stocks like GameStop and AMC just a few weeks ago, I wanted to make a video to explain exactly the step-by-step process of how trades are executed, all of the participants that are involved with it, and then try to help you guys figure out if what they did was legal, illegal, moral, immoral. It's going to be up to you by the end of this video. So if you haven't seen my GameStop video already, I suggest you check that out before continuing this video. But without further ado, let's get into today's topic. So when it comes to trading any kind of security, in our case, more than likely it's going to be a stock. There are 5 main components and key players that are involved in ensuring that everything goes swimmingly and everything is done correctly. There are exchanges, there are brokerage houses, there are market makers, there's custodians, and last but not least, there are clearing houses. I'm going to explain the function of each 5, and then I'm going to make a little spider web to show how they all connect to one another, and then we could finally figure out exactly how securities are traded. Let's start off with exchanges. So some examples, some exchanges that are primarily used in the United States are the New York Stock Exchange, NASDAQ, and the Intercontinental Exchange. Each country has its own exchange as well, often more than one. But exchanges serve as the common meeting ground for buyers and sellers of all securities. It is where companies initially go public for the first time, where they list their shares for an IPO. Securities are listed here, and individuals can post how much they're willing to buy or sell the securities for. Exchanges are there to provide efficient and fair pricing, timely and accurate trading information distribution, and it also maintains records and data for everyone to understand and to make sure that everything is universally known. Next up are brokerages. Brokerage houses serve as the bridge between exchanges and investors like you and I. They provide the market data that we want to look at, and then they go ahead and they process our buy and sell orders for the securities that we're interested in. They provide other services that we can't get directly from an exchange, such as consultation and support and things like that. But at the end of the day, their main job is to link buyers and sellers and to ensure that people are receiving the best price. Now we have the market makers, which is a little bit complicated to understand, but by the end of this video, I'm sure you're going to have a really good understanding of what they do. So in an ideal situation, a brokerage firm is going to have person A, who's going to want to buy 100 shares, and person B, who's going to want to sell 100 shares. These people match up perfectly, they buy and sell respectively, and everything's okay. However, what if we have person A who wants to buy 100 shares, but there isn't necessarily a person B matching their 100 shares that they would like to sell? That is where market makers come into play. A market maker's job is to provide liquidity and set prices for the securities that they, quote, make a market in. Market makers are not investors, nor do they trade based on an expected direction. They're only there to provide liquidity and help market participants buy and sell what they want when they want. They are often regulated and they have restrictions on the prices that they can set into the exchange. When talking about market makers, we need to talk about order flow. When brokerage firms have orders come in for buys and sells, they don't actually go out and buy and sell your stock themselves. What they actually do is they sell the order flow to market makers. Now you're probably asking yourself, okay, why would a market maker buy the rights to execute on your transactions? The answer is,
hello, I like money.
now you're wondering how exactly do they make money? So market makers make money off of something called the bid-ask spread. When you place an order on your brokerage, if you're selling something, you're actually selling it at a slightly lower price than the real market price, and when you buy something, you're actually paying a little bit higher of a price than the real market price. The bid-ask spread varies across stocks. Some can be low as a penny, while some can reach as high as 1% of the stock price. Now recall the situation where we have person A who wants to buy the shares, but there's no one to match the other side of the order. Let's say the market price is $10. A market maker is going to come in and sell the share to person A for $10.01, which is their ask price. And almost simultaneously, they're going to go out and buy it on the open market for $9.99, which is their bid price. So the market maker just made that 2 cents off that transaction instantaneously, and it's justified because they're the ones that provided the liquidity to facilitate the transaction on both sides. Flipping the transaction, if person A wanted to go ahead and sell their share, they would be selling it at the bid price of $9.99, and the market maker would go ahead and immediately sell it for their ask price to someone else for $10.01. It kind of sounds like a scam at first, but trust me, this is extremely important as it does provide a lot of liquidity and it guarantees that we're going to have our orders processed almost instantaneously from our end, and it ensures that the markets are running efficiently. Market making is an extremely lucrative business. These people can make quite a lot of money, but at the same token, they can lose a lot of money. Their main goal is to ensure that they do not have any open positions. So when they enter a position, they want to close it as soon as possible. And when I mean as soon as possible, I'm talking within a second or two. And in some cases, if they cannot match that other side of the order and the market moves in the opposite direction, they can get burned. This is something to remember later on in the video. Next, we have custodians. Literally, custodians are like a bank, but for your securities. They just make sure that they're in a safe spot, whether it's digital or physical. Think about you take your money, you take it to a bank, and they keep it for safekeeping. Custodians will take your shares and your securities, and they keep it for safekeeping. Finally, we have clearinghouses, which is also going to be something important to understand later for this video. Clearinghouses are the final step in a securities transaction. When the buyer and the seller are finally all matched up, they step in between the final step and they act as the intermediary to simultaneously buy and sell from the respective party. And then they settle both sides in regards to confirmation of shares and cash that's being transferred. Now, if one party were to somehow default, then the clearinghouse is actually on the line for that. So, in return for that really, really minute risk, these clearinghouses charge fees to brokerages along with creating strict guidelines and deposit requirements that the brokerage houses must adhere to. Keep this one in mind as well. Now that you have all the pieces together, let's put up the magical spider web. So we have someone buys, someone sells. They each have a broker, which has a custodian. When a transaction is matched based on the prices that the market makers provide through the exchanges, a clearinghouse to make sure that everything checks out and it allows the transaction to go through. The end. Smash the like button if you finally understand how trade execution is completed. Now that we have all the moving pieces together and we finally understand how all this trade execution is done and we know the relationships between those 5 organizations, let's talk about how Robinhood decided to show all of these messages regarding AMC and GameStop and how it restricted retail investors from buying any more shares of the stock, but apparently they allowed institutions to buy and sell freely. Now your next question of the day is why would brokerages do that in the first place? It all comes down to the fact that me and you are allowed to trade for free now. Just as recent as 10 years ago, that was not the case. It used to cost $5 to $10 just to make one trade in one direction. So if I had $100, I had to pay 5 or $10 just to go ahead and buy something, which means I'm out 5 to 10% right off the bat. And to make matters worse, I have to do the same thing when I sell. So now if you want to invest $100, you're already down $10 to $20 just off of existing. So this restricted a lot of retail investors from getting started in stock trading and investing because they just didn't have the money to justify those fees. Robinhood actually came along and said, yo, 0% fees, let's get everyone trading. Their logic is that they can get a lot more retail investors involved, which means that they can get a really big order book, which means that they can go ahead and sell that massive order book for quite a sum of money to market makers and other institutions that would either take the opposite side of us because they knew that we were wrong because we were, quote, not smart enough like the big institutions, or they would just go ahead and make the bid-ask spread that I explained earlier in this video. The main issue here is that these institutions that are buying the order book from Robinhood and Fidelity and other brokerage services that did the same exact thing that I mentioned, they also happen to be shorting GameStop. Kind of seems like they have a little bit of power here, don't they? Robinhood went out and released a statement by emailing every single one of its users these remarks, which in a nutshell basically state that their deposit requirement with the clearinghouse was not met due to how much stock its users had, which in this case was GameStop. And since stocks like GameStop and AMC were insanely volatile, and in GameStop's case spiked as high as 1,200% in such a short time, the deposit requirement also skyrocketed. This was their fundamental reason for why they halted buying more shares of GameStop for retail investors, because if they bought more, that means they increased their deposit requirement and it created a catastrophe that they basically could not afford. So remember how I mentioned that the clearinghouses had these requirements that brokerage firms had to meet in order to be able to transact certain stocks. It essentially was not met. But this is the fundamental problem. They were still selling the order book. On GameStop, the order book was primarily only sells to the institutions that also had the short positions, meaning they had to buy it. When you have a bunch of panic sells go over, people tend to ask lower and lower prices, which made GameStop almost crash as low as $156 that day. But since that order book was one-sided, the same institutions shorting it were able to go ahead and take the opposite position of that order book and close a lot of their short positions, thus curving a lot of their losses, and in some case making money if they shorted it at the top and then saw that 50% decrease just in one day. Now that you have a little bit more color on how trade execution is done, why they legitimately had to halt shares from being purchased, but also now you know what was going on in the background and how they did not halt that, do you believe there should be some sort of class action lawsuit? Is this like mesothelioma where we should be entitled to financial compensation? Drop your comments below. And as always, thank you so much for watching. If you enjoyed this video, please give it a thumbs up. If you like videos like this, please subscribe to the channel and stay tuned for more content. Thank you guys so much.
Attention! If you or a loved one was diagnosed with
GameStop.
you may be entitled to financial compensation.